The world is a tumultuous place right now. Inflation is soaring, eating away at our savings and making it harder to afford basic necessities. In these uncertain times, people are looking for stability, a safe haven for their hard-earned money. And that's where gold comes in, shimmering alluringly as a beacon of hope. For centuries, gold has been a safe haven asset, a store of value that has endured wars, recessions, and financial crises. Gold has always held a certain mystique, a captivating allure that has drawn people to it for millennia. Its beauty, durability, and scarcity have made it a prized possession throughout history. But gold is more than just a pretty face. It's a powerful economic force. Today, as we stand at the precipice of what some believe could be the greatest economic crisis in our lifetime, gold is once again shining brightly. The prediction of gold hitting $27,533 an ounce is a bold one, to say the least. Proponents argue that gold is simply returning to its intrinsic value, a value that has been suppressed for decades by artificial market manipulation and government intervention. Skeptics dismiss this prediction as pure fantasy, arguing that gold is a volatile asset prone to wild swings in price. Gold, throughout history, hasn't just been a shiny object of desire, it's been a silent witness to the ebbs and flows of empires and economies. From 1971 to 1980, gold prices surged by a staggering 2,500%, a testament to the inflationary pressures and geopolitical uncertainties that gripped the world. The lesson from the 1970s is clear. When faith in the established financial order wanes, gold shines. August 15, 1971. President Richard Nixon announced the end of the Bretton Woods system, effectively severing the dollar's direct convertibility to gold. The immediate impact was a sharp devaluation of the dollar and a surge in the price of gold. The Nixon shock wasn't just a technical adjustment to the monetary system, it was a paradigm shift. Fast forward to the present day. The global economy is once again teetering on the edge of uncertainty. In this environment of uncertainty and fear, it's no surprise that investors are once again turning to gold as a safe haven. The question is, will history repeat itself? Will we witness another gold surge of epic proportions? The world today is drowning in debt. Governments, corporations, and individuals have taken on unprecedented levels of borrowing. This mountain of debt is one of the most compelling arguments for gold's potential surge. In this environment of heightened risk and uncertainty, investors are likely to seek refuge in safe haven assets like gold. Inflation, once a dormant beast, has roared back to life, its fiery breath scorching the purchasing power of consumers. This inflationary environment is a boon for gold, which has historically served as a hedge against inflation. As inflation erodes the purchasing power of paper money, investors often turn to hard assets like gold. The US dollar, long considered the world's reserve currency, is showing signs of vulnerability. This potential decline of the dollar is another factor that could propel gold prices higher. Investors are increasingly concerned about the potential for inflation and currency debasement, prompting them to seek alternative stores of value, such as gold. The world today is a tinderbox of geopolitical tensions, with conflicts simmering and erupting in various regions. These geopolitical tensions create uncertainty and fear in the markets, driving investors towards safe haven assets like gold. As geopolitical tensions continue to simmer, it is likely that gold will remain a sought-after asset, potentially driving its price higher. Predicting the future in finance is a fool's errand, as any seasoned investor will tell you. Markets are fickle, influenced by countless factors, making predictions nearly impossible. Yet some dare to gaze into the crystal ball and offer their predictions. The chorus of voices on gold is particularly loud, with a wide range of opinions. Some remain optimistic, citing gold's role as a safe haven and inflation hedge. Others predict a surge in gold prices due to geopolitical instability and currency debasement. A few stand out for their bold, contrarian views, challenging conventional wisdom. These mavericks question the status quo and present divergent visions of the future. Their insights prompt investors to reevaluate portfolios and consider unexpected futures. Peter Schiff, CEO of Euro-Pacific Capital, is known for his bearish outlook on the U.S. economy and his advocacy for gold. Schiff predicts gold will hit $27,533 an ounce, based on economic fundamentals and historical trends. He argues that massive debt, reckless spending, and easy money policies will drive investors to gold. Schiff believes a return to the gold standard is inevitable, despite potential economic upheaval. His views, once dismissed, now seem prescient as inflation surges and debt levels soar. The question of whether gold will reach $27,533 an ounce, or any specific price point for that matter, is ultimately unknowable with absolute certainty. The financial markets are complex, dynamic systems influenced by a multitude of factors. Could we be witnessing the early stages of a paradigm shift, a fundamental realignment of the global financial system? The current system, built on fiat currencies and debt, has shown signs of strain. As governments and central banks grapple with the economic fallout, concerns about inflation and currency debasement have grown. Gold, with its long history as a safe haven asset, has always held allure during times of economic turmoil. The question is not whether gold will continue to rise, but how high it will go and what role it will play in reshaping the global financial system. The financial world thrives on debate, a constant tug-of-war between bulls and bears, optimists and pessimists, those who see a bright future and those who foresee storm clouds gathering. The prediction of gold soaring to $27,533 an ounce is no exception, igniting a firestorm of controversy and attracting a chorus of skeptics eager to poke holes in this audacious claim. These skeptics, often found in the hallowed halls of academia, central banking, and traditional investment firms, scoff at the notion of such a dramatic price surge. Armed with charts, graphs, and complex economic models, they argue that gold is simply a shiny metal, lacking the inherent value attributed to it by its ardent supporters. They view the current rally as a speculative bubble, fueled by fear and irrational exuberance, destined to burst, leaving investors who bought in at the top with nothing but fool's gold. Gold doesn't generate income, they proclaim, pointing to its lack of dividends or interest payments. It's a barbarous relic, they declare, dismissing its historical significance as a monetary asset. They argue that in a modern digital economy, gold is nothing more than a quaint collectible, a relic of a bygone era. Its price, they insist, is driven by speculation and emotion, not by sound economic fundamentals. These skeptics point to the many times in history when gold prices have surged, only to crash back down to earth, leaving investors nursing their wounds. They caution against buying into the hype, warning that those who ignore history are doomed to repeat it. Their arguments, often presented with an air of intellectual superiority, carry weight, particularly among those who view gold with a healthy dose of skepticism. The word bubble sends shivers down the spines of investors. It conjures up images of irrational exuberance, of markets detached from reality, of prices soaring to unsustainable heights, only to crash back down to earth. For skeptics of the $27,533 gold prediction, the current rally has all the hallmarks of a classic bubble. They point to the sharp rise in gold prices, fueled by the unprecedented monetary and fiscal stimulus from the COVID-19 pandemic. This flood of liquidity has inflated asset prices, creating a speculative frenzy. This time is different. A phrase often uttered at the peak of market bubbles is met with derision by the skeptics. They argue that while circumstances vary, the dynamics of bubbles remain consistent throughout history. Irrational exuberance drives prices higher, attracting more investors, until the bubble can no longer be sustained. For them, the current rally is a speculative bubble driven by emotion, destined to burst, leaving investors holding the bag. Gold, for all its allure as a safe haven asset, has a reputation for being a volatile investment, prone to wild price swings that can leave investors both exhilarated and terrified. This volatility, while attracting traders who thrive on market fluctuations, gives pause to those seeking long-term stability and predictable returns. For skeptics of the $27,533 gold prediction, This inherent volatility is a major red flag, a sign that gold is not the safe haven its proponents claim it to be. They point to the historical price charts of gold, which resemble a roller coaster ride, with periods of sharp ascents followed by equally dramatic declines. While gold bugs often highlight the long-term upward trend in gold prices, the skeptics focus on the short-term fluctuations, the sudden drops that can wipe out gains and test the nerves of even the most seasoned investors. Gold is not for the faint of heart, they caution, warning that its price can be influenced by a myriad of factors, from macroeconomic data releases to geopolitical events, central bank pronouncements, and even rumors and speculation. This sensitivity to external shocks makes gold a risky bet, particularly for those who are not comfortable with the prospect of seeing their investments lose a significant portion of their value in a short period. The skeptics argue that while gold may offer a hedge against certain risks, such as inflation or currency debasement, it is not a foolproof insurance policy. Its price can and does go down, sometimes significantly, and investors who are not prepared for this volatility may find themselves on the wrong side of the trade, facing substantial losses. For them, the risks associated with gold's volatility outweigh the potential rewards, particularly when the price is at such elevated levels. So will gold really hit $27,533 an ounce? It's a question that sparked heated debate, dividing the financial world into camps of believers and skeptics. The truth is, no one knows for sure. Predicting the future, especially in the unpredictable realm of finance, is a fool's errand. The markets have a funny way of humbling even the most seasoned experts. On one hand, the economic landscape seems primed for a gold rush. We're grappling with unprecedented levels of debt, inflation is rearing its ugly head, and the world stage feels increasingly unstable. These are the conditions that have historically sent investors flocking to gold's safe haven. Add to that the predictions of respected analysts like Peter Schiff, who make compelling arguments for why gold is significantly undervalued at its current price, and the prospect of a $27,533 gold price doesn't seem so outlandish. It's a bold prediction, sure, but one that's rooted in a deep understanding of economic cycles and the precarious state of the global financial system. However, the skeptics also raise valid points. Gold is a volatile asset, prone to wild swings that can leave investors with whiplash. The current rally could indeed be a bubble, inflated by fear and speculation, ready to burst at any moment. And let's not forget that gold doesn't generate income, its value lies solely in what someone else is willing to pay for it. In the face of such conflicting narratives, what's an investor to do? The key is to approach the situation with a healthy dose of prudence and a clear understanding of your own risk tolerance. Don't let fear or greed cloud your judgment. Blind faith in any single asset, even one as historically resilient as gold, is rarely a winning strategy. Instead of betting the farm on a single outcome, consider diversifying your portfolio across a range of asset classes. Stocks, bonds, real estate, commodities, each has its own risk and return profile. The goal is to create a balanced portfolio that can weather market storms and capitalize on opportunities as they arise. If you're considering adding gold to your portfolio, do your research. Understand the factors that influence its price, both in the short term and the long term. Consider different investment vehicles, from physical gold to gold ETFs and mining stocks. And most importantly, only invest what you can afford to lose. The future is inherently uncertain, and anyone who claims to have it all figured out is likely selling something. The best we can do is make informed decisions based on the best available information, manage our risk carefully, and be prepared to adapt as the economic landscape evolves. Whether or not gold hits $27,533 an ounce, one thing is clear: we live in uncertain times. The old economic order is creaking under the weight of its own excesses, and a new paradigm may be emerging. In this environment, it's prudent to consider assets that have historically held their value during periods of turmoil. Gold has been a store of value for millennia. It's a tangible asset with inherent scarcity, a hedge against inflation and currency debasement. While its price may fluctuate in the short term, its long-term track record speaks for itself. Adding gold to a diversified portfolio can provide a measure of stability and act as a hedge against systemic risk. It's not a guaranteed path to riches, but it can offer peace of mind in a world where the future seems increasingly unpredictable. Ultimately, the decision of whether or not to invest in gold is a personal one. Weigh the arguments carefully, consider your own financial goals and risk tolerance, and make the decision that's right for you. One thing's for sure, in these uncertain times, a little gold might just be the hedge you need.